VOO is one of the greatest ETFs on the market. It's got a low price, it's got a great returns, and it's a great ETF that you can buy and hold for your portfolio. And in today's video, we're going to be talking about, is $50,000 in VOO enough to crush your full-time job? Hey guys, my name is Steve, and I run the Frugal Expat website where we try to help people to save more and invest better. Today, we're going to be talking about, is $50,000 into VOO enough to crush your full-time job? So let's get to it and let's start talking. You know, VOO is one of those great S&P 500 ETFs. Now, the reason I talk about S&P 500 ETFs because it is a great way to kind of buy and hold the entire US stock market. Well, the entire large cap part of the US stock market. The S&P 500 index has been around since 1957, and it tracks the top 500 companies on the US stock market. So when people talk about the market, they're actually usually talking about the S&P 500. This index has been around since 1957, like I have said. It has an average annual return of about 10.33%, which is great, but the real returns when you subtract inflation is about 6.47%. So let's keep those numbers in mind. So it average returns around 10% with a little bit over 3% in inflation. So you're talking about maybe a 6 to 7% real return of your money. So when we're thinking about kind of investing for the long term and we don't know what is a good ETF to invest in, we got to look at a couple of different factors. We need to look at, if we want to make it simple, then a good broad market ETF would be a simple approach to create a portfolio. And some great broad market ETFs would be VOO, SPY, SPLG. Those track the S&P 500. Or if you wanted a total stock market index fund or ETF, VTI or even SCHB would be great ones to buy and hold for the long term. Personally, I have about $190,000 into VTI, and that is not VOO, but VTI does have about 87% of its holdings in the S&P 500. So it's basically like an S&P 500 ETF because it holds almost all of its money in the top 500 companies on the US stock market. So if you're looking for a great ETF to buy and hold for a long term, VOO could be the ETF to buy and hold. Why would an ETF be better than maybe investing into stocks? Well, first of all, when we're looking at different stocks, you could think about Tesla, maybe Apple, maybe Microsoft, and you're thinking about, all right, could I buy this and hold it for the long term and think about be better than buying like maybe a simple ETF? Well, if you take a look at the last 10, last 20, last 30 years, well, last 10 years, so you're thinking, all right, Apple, Microsoft, they're doing great. Amazon's doing great. But think about this. 30 years ago, was Apple doing great? Was Microsoft? They may have not been in the top 10, top 20 of the S&P 500. So markets go up and down and stocks go up and down, but do you have the patience and the endurance to kind of figure out which stock's going to do the best? Do you want to look up all the information? Well, most investors don't. And so the simple way to do it is to buy a simple index fund or ETF like VOO or VTI to kind of buy and hold for the long term. As the market changes, as stocks and companies go up and down, you'll still hold the same one and they will kind of add and subtract the ones that are not doing as well. Now, the S&P 500, like I've said, it's been around since 1957. It's got the top 500 US companies on this stock exchange, and it is a weighted index, which means the companies that have the most market cap will be at the top of the index. So when we're looking at companies like Apple, Microsoft, and Nvidia, these companies are at the top because they have the most money in the market cap of these companies. So if you're looking for some great companies, these are some great places you can look at. So that's good news for you. If you want a simple approach, then an ETF makes it simple for most investors. If you want to dive deep into all the financials in all the ways a certain stock could go up and down, well, you can do that. There's no rule that says you can't. But for me, as I look for simple investments and I look for trying to create a portfolio that I don't have to spend hours and hours of weeks trying to figure out what are the best investments, a simple ETF makes it simple for my portfolio. And it should make it simple for your portfolio as well. So that is why we pick like an S&P 500 ETF or a good broad market ETF. It is a good way to hold some of the best companies on the US stock market, and it is a great way to kind of increase and grow your portfolio for the long term. It's got some great different sectors that it can help you create a great portfolio. Right now, VOO is got about 32% of its portfolio in technology. It's got about 14% in financials, and it's got healthcare being the next one with consumer staples and consumer defensives right behind it. So you're talking about a well-diverse portfolio full of tech, financials, healthcare, consumer staples. These are some great sectors to kind of help you with your portfolio. Tech's gonna be kind of the up and up. Then you have financials being a little bit more stable. Then you have some healthcare. You have a little bit of consumer staples, bringing in some of those blue chip companies like Walmart. So these companies bring in and create a great portfolio to help you kind of make some money off in the long run. Now, when we're thinking about growing our money, like if we put in $50,000 into this ETF, we wanted to see if it grows and gets past what we want in our portfolio. We want to see if it's going to crush our everyday job. Now, if you think about our everyday jobs, and most on the average in America, the median income is going to be around $60,000. Now, of course, people are going to be making more, people are going to be making less, but that's just like a roundabout number of a median income in the USA. And you think about, all right, how much do I need to kind of bypass that in the long run? We'll get to that, and we'll see how compounding interest is going to grow this money for the long term and make you rich. All right, let's get to it. Now, if we were to start with our $50,000 and did not invest a single dollar more, and we were to invest it at a rate of 10% per year, being that return of the S&P 500, after 30 years, that money will grow to about $991,000, which is amazing news. At 35 years, it'll grow to $1.632 million, and at 40 years, it will be about $2.68 million. Now that is amazing news if you just put it in there and you let it grow and grow for 30, 35, or 40 years without putting any more money in it. Now, if you were to put more money in, let's say $10 a day or $300 a month, that money is going to compound to amazing numbers. At 30 years, it'll get to about $1.677 million, and at 35 years, it'll be at $2.77 million. Now, that is amazing news. Just at a 10% return, investing just $10 every single day for the next 35 years. Now, these numbers look great, and you're wondering, are these real numbers because of inflation? Well, like I said in the beginning of this video, you know, the S&P 500 has had a return of about 10.33% and a real return of about 6.47%. So if we were to say it's going to have about a real return of about 7%, now these numbers are going to change just a bit. So let's see what those numbers are if we just added $10 per month for the next 30 and 35 years. For the next 30 years, it'll be about $771,000. And over the next 35 years, it'll be $1.55 million. So as you can see, the 7% gives you a little bit less return, and it's a better and real return. So if we're thinking more conservatively instead of more aggressively, we will not be kind of overreacting when our money hasn't grown and we're like, that's Steve, that Frugal Expat, he gave us 10%, now we're just getting 7%. We gotta look at those real returns. Real returns give us a better picture of what our money could be doing. Now, if we were to add $500 instead of $300, of course that money's going to be even higher and probably closer to what we were looking for. So the question really is, will $50,000 into VOO be enough for us to retire on, or be enough for us to crush a real-time job? Well, the simple answer is no, it probably will not be. And the reason I say that is because if you're making about $60,000 a year and you have a real return of about 7%, you need to be putting an additional $500 every single month to get to the point where you can retire and you don't need as much money. And that means at $60,000, if we wanted to get that $60,000 in real returns at the age of 60, 65, 70, you need to times that by 25. And that would be about $1.5 million. Now, the reason I do that is because at $1.5 million, you can take about 4% out per year, and it would be around $60,000. And that's great news. Now, will $50,000 get that without investing anymore? Well, if it's at 10% return, well, yeah, those numbers, I already given you those numbers. At 35 and at 40 years, you're going to be getting some of those numbers. But at a real return, you're going to be needing to invest more money. That is not an issue. That's just being a little bit proactive instead of just putting some money in and hoping it grows to the point where you hope to retire. But at real returns, and you want to get get to that $60,000 per year, crushing your full-time job, you gotta think about inflation. You gotta think that the market may not do as well as it's been doing for the last 10 years. Over the last 5 years, VOO has been averaging about 15.90%, and over the last 10 years, it has averaged about 12.85%. Now, those are amazing numbers if you think about it, but will the next 20, 30 years be like the last 10 years? Well, maybe not. It could be better. It could be worse. So we always have to think about in those terms. We gotta think about, what are we gonna be doing in the next future? Will we be needing more money? Will we be needing less money? Secondly, will our returns be as good as it has been the last 10 years? Well, it may not, and it could be, but we have to plan for it probably not as good, so then we can have a better returns in the future. Let's say if we plan for 7% and the real returns are 10%. Well, that's good news. Maybe you can retire early. Well, but if real returns are 7% and you've been planning for 10%, well, then your plans have been been losing, and so then you should have been planning for more. So what I want to do is make you to think about investing more. First of all, you could start off small. If you could get $50,000 into VOO, that's great. And you just got to start adding more and more every month. It could start off with at $100 a month. You could be trying to cut maybe something out of your spendings, and so you can put an extra $100 every month into your investments. Maybe you think, all right, if I could get up to $300 or $10 a day, could that be something even better? Well, yes, of course. And that may be starting a side hustle. Maybe you do some sports refereeing on the weekend. Maybe you do some door dashing or some Uber. Maybe you do some online surveys online to add just a little bit of extra money. I used to do soccer refereeing, and I could earn anywhere between $100 to $300 on a weekend, and that could be extra money that you could put into your investments. And if you can get up to $500, that's even better. And if you really wanted some tax-free income for your retirement, well, just put it all into a Roth IRA. A Roth IRA gives you tax-free income after you hit the age of 59 and a half, and that is great if you put all this into your Roth IRA. Now, right now, you can invest about $7,000 a year into your Roth IRA, and that's a great news. I mean, that's a little bit more than $500 a month, because $500 a month is about $6,000, so now you can do $7,000. So take some advantage right now. Is VOO a great investment for your future that could crush your job in the future? Yes. It can. Will $50,000 do it and no more invested? Probably not. So what we try to do is we could start with getting that $50,000 invested and then continue to put more and more money until the point where it's just going to compound over time, and to the point where it's going to surpass your full-time job and you'll be able to retire on a comfy retirement. So think about some of those things. Think about how to do that. And if you like this video, you should check out one of my other videos on a great 3-fund portfolio up here, or even one on how I'm going to retire off of VTI right over here. All right, I'll see you in our next video, and you take care and you keep investing for the next day. All right, see you guys.